Well, hello everyone. Don Garman here again. It's August. I'm not going to say happy Friday, but as I periodically do, we like to be in touch uh, regularly or more than regularly during times of acute stress. So I'm not going to over dramatize it, but I am going to share some of what's happening and some of the tension that's going on, and the reason that you will notice we've taken some pretty, uh, I would say, serious steps toward switching our positioning, even as recently as this morning. So we have been sort of sailing along, right, with the AI narrative and the expectation that the spending would translate into more revenue, and that's been the sort of way we've gotten through this year so far. And while we were watching as the Fed raised rates and the effects that that would have on the consumer, the labor market remained strong. And what that led everyone to conclude is, as long as the consumer, the American consumer, is employed, they will spend. And when they spend, the economy is going to be fine. It's going to chug along. And so two things happened over the last 3 days that have challenged that prevailing narrative. The three things are the technology companies that we all know by name, that we've come to know and love, that are large weightings in our strategies and in our portfolios, all reported earnings for the last quarter. And I think objectively were basically good earnings, right? They make gobs of money. They produce gobs of revenue. We all use their products every day. We love the companies and the businesses. And each of them, even if they traded up in response to their good earnings, almost immediately gave it all back the following day. So they've all traded poorly. And that, I think, is a tell on where expectations are. Sometimes, occasionally, even the best companies are not priced to be good investments. So that caused us to sit up and take note. We talked as recently as last month about the shift into, or a broadening from just the 7 stocks, the magnificent, which it was really 5, was broadening. And in reality, in the last 30 days, that really did happen. There was a huge transition from the few to the many, and it was breathtaking in its swiftness. And just as breathtaking the last couple of days, it has been largely reversed. So I think for all of our sake, it's best when the facts change that we reassess. And so we are taking a preliminary but non-trivial action of dialing the volume down. And this was a process that, and I don't want to draw any comparisons to '08, but this was a process that we did on a regular basis in '08. Think of it like squeezing a brake pedal as you're going downhill. First lightly, and then as you accelerate or you continue to accelerate, you put more pressure on the brake. So the brake was very lightly touched a week ago and is a little more heavily touched right now. And as a result, we come off the accelerator a little bit more on the brake, and that will be the process of sort of moderating the math of what we're trying to achieve from a return and standard deviation risk perspective. Now in August, going into August, September, no more earnings really, although there are some remaining, but the biggies have reported now until October. I don't put a lot of faith in these type of cues, but August and September, we've all recall, are generally not the greatest months, because as we've come through this year, people now coming back from vacation. I said it actually last month. I looked this morning. I said, expect volatility to return. It's not pleasant on the down days for sure. And we certainly feel that. But what I would urge everyone to do is, maintain the center of the teeter-totter approach and understand that whatever is happening at the moment, this violent disagreement between are we going to be fine in the economy, or the unemployment numbers today suggest much less. The job market is softening. So whether that accelerates and turns into what we might start talking about as a potential recession, that is in essence the debate that's being contested in stock prices today. The other thing that's happening underneath the surface, the third thing, is the initial hints of what might be a credit challenge. So what you can witness is auto loan delinquencies, people not making their car payments are rising. People not making their credit card payments are rising. So it could be the speed of the interest rate increases and what the Fed has called the long and variable lags, that people were, running even more breathlessly, but sort of not falling. And now it appears that maybe some people have kind of gotten to the end of the rope. We all know how much more expensive things at the grocery store are, and everywhere in life, auto insurance and home insurance and all the different things that we all have to pay for, unquestionably more expensive as a result of that 2-year inflation surge that we've just hopefully come through. So what I wanted to say is, ordinarily I wouldn't come out until next Tuesday, but I think it's warranted given the violence of the move the last couple of days. I'm taking it seriously. I feel like there is this is a moment where things might be shifting more dramatically. So I'll pay very close attention, as I always do, but particularly over the next several days and weeks. Really, the next couple months, there won't be much of a catalyst until we get to September. And then, of course, we all expect the Fed to cut. Hope that's going to be the first of many, and who knows if that's going to be a good thing, because if the economy's already slowing quickly, that again might be too late. So we have to be vigilant, as we will continue to be. So I'm sure you'll notice. Please reach out with concerns or comments or any further discussion. But I will, maybe even reach out inter-month, depending on how things go. Again, I don't want to have anybody over focused, but I certainly will be out, discussing what's happening if things are acute, as they certainly are today. So with that, I will leave it there, and thank you all. And until next time, we will catch up soon. All right, bye.